All right, everyone, welcome back for another episode of This Week in Charts via Carnivore Trades and Wall Street from Main Street. If you're not done so already, give the video a thumbs up, subscribe to the channel, comment, come find Jason on Patreon, or come find me on carnivoretrades.com for swing trading, alerts, and analysis. Anyways, here, Spiders had a big move up this week. You can see here on Wednesday, about 4% up from Tuesday to Friday there. Obviously, on the CPI data, last week we talked about we were kind of coming into resistance. We're closer to resistance than we are to support. But, sometimes you can get through that. We did put in a little consolidation there. You can see how here on the E-mini, we kind of went sideways here. You got kind of a bull flag sort of building up. And, it was much like this one back in May that ended up failing, ironically, on CPI as well. But this print obviously coming in cooler than expected. And market like that, obviously. Reason being is that everybody's now pricing in a Fed pivot. They're now pricing in stimulus. Everybody's thinking we're going back to all-time highs. Anybody who's bearish is basically getting dragged through the mud on Twitter. It's we're starting to see that really bullish sentiment start to come back here, and I don't think that's necessarily warranted. So basically, yes, I do think the Fed will pivot. They'll probably slow down. We're looking at probably 25 to 50 basis points hike in September. That's what the market's kind of pricing in right now. But that doesn't mean that the Fed is going to be able to do QE like they did in the past. And what I mean by that is inflation's not going anywhere. It's not going to go down to 2% like the market is kind of pricing in right now. We're kind of climbing up on hopium and kind of climbing the wall of worry. And basically, I mean, maybe inflation does, crash if the economy comes into a tighter recession here, but maybe it gets down to 5% at some point. But we're realistically looking at the average to be around probably 6 to 7%, and that's headline CPI, which we know is not even really the actual inflation. But the market's not really pricing this in, and the bond market is though, and that's really kind of the whole basis here. So the bond market's kind of calling this rally's bluff, essentially. So if we take a look at the 210 spread, it down ticked Wednesday, Thursday, but Friday it ticked back up, held that 20 moving average. This is still a really strong uptrend here, above all the moving averages, and it upticked on Friday. If the Fed is supposedly going to bail us out and do all this stimulus, why are the 2s and 10s continuing to invert further? You see the same thing here on the 3-month and the 10-year. It backed off Thursday, Friday, but held the 20 moving average, got a bid on Friday. So this is close to inverting as well. 10-month and 3-year also got a bid last week. We talked about that. Backed off for 2 days and then got a little bid on Friday. Let's flip back over here and we'll take a look at the actual 2-year. But this is what everybody needs to be watching right now. If the 2-year starts selling off further, which it already kind of backed off a little bit on Thursday, Friday, but this should be ripping higher. I mean, if the Fed is supposedly going to do all this QE and we're going to blast off back to all-time highs, why aren't bonds ripping higher? People would be front-running the Fed. The bond market would be front-running the Fed, and we're not seeing that right now. Mortgage rates also, take a look here. The 30-year, that bounced, that back tested that 5% area and got a bid off of that, back above 5.2 now. So that is starting to uptick as well. The bond market really, to me, is just not confirming this. And additionally, if we take a look at the spiders here, and you can really just see, ever since this rally started, it's been really light. This is kind of, we were talking about this. It was going to be a summer rally. It's going to be, a summer doldrums type rally, and this is what we got. The volume's declining. That's showing you that institutions are not participating. This is retail, it's algos, HFTs pushing the market up right now. So I think the market is eventually going to have to, it's going to come to the realization that these things are still on the table, that inflation's not going anywhere. But for now, the market can hold up, and we got to respect the light volume. Once the volume comes back, we get closer to September, we're in a period where kids are, kind of getting ready to go back to school. Once all that stuff kind of clears out and we get through the last parts of the summer here, I think this market's going to come to the realization that, things are not exactly what they're saying on TV right now. But anyways, here also take a look at the VIX. This is just showing you the complacency here of the market. Take a look at the VIX. So 9 straight weeks in the red there. Market's getting really, complacent and kind of just thinking that, oh, everything's fine, and it really isn't. And I think the bond market is really telling us that. Anyways, here, let's flip over, talk about a few sectors. So semis also bidding up here, had a little bit of a sell to news on the chip build earlier this week. Did manage to recover, held the 20 moving average. You still have a little resistance up here, but you kind of pulled back ahead of that. So this may get through that. And then, if it does, you got a gap up here, which kind of coincides with that 200 moving average. So semis holding up just like the rest of the market. IGV, cloud software here, continuing to rally, but did have a pretty good reversal candle on Thursday. So we'll see if that comes into play next week. But, it bounced on Friday. Still got a lot of resistance up here with this red bar. But, cloud rallying just like everything else. Dow transports. Stalled out at that 200 moving average. If it gets through that, maybe you can go up here and fill this gap, and that would also be back testing kind of that breakdown area from earlier this year. But, again, everything, really all sectors rallied this week, and, that's just the nature of the light volume, the summertime. It's usually you get shallower dips until really kind of September, and you get that kind of seasonal downtrend. But anyways, let's talk about rates here. So 10-year continuing higher, and again, same thing here, is bonds should be bidding right now, and they're not. And we talked about this a week or two ago. We talked about the failed head and shoulders here on the 10-year, and we got a nice little consolidation here and a pop on Thursday before a little micro kind of inside candle here on Friday. So rates are not confirming the rally here in stocks. You see the same thing on the 30-year monster bid on the yield on Thursday. So yields are really kind of contradicting this rally, and the bond market's usually ahead of the stock market. So while stocks may be able to rally here in the near term, there are going to be some problems down the road here, especially with this inverted spread. Home builders here pushing higher. Again, everything had a rally this week. Short term, maybe you can get back up and fill this gap here. You'd have the 200 moving average above here on the XHB, ITB, a little bit on the softer side. This carries a little bit more of the retail names, but again, kind of, gap up here, and then there's that 200 moving average there on the upside. VNQ here, same kind of deal. So right into this area, and we can kind of go back a little bit so you can see where that pivot is. That was support for a very long time, that broke. So now that should be resistance right here as we go into it here on the backside. And then, of course, you have that 200 just above that. So a lot of charts coming into that kind of 200 moving average area. You can see the same thing on the spiders here, just above that. And the same thing on the semis. We talked about IGV there as well. So pretty much the same thing across the board here. XLF, a little bit more extended from its 200 here, but a nice bid here. I mean, this thing has just been a powerhouse gap, leaving a lot of gaps on the chart though, so be careful of that. It would not be a buyer of this up here. There is a gap fill right up here around 36.06, and then there's that 200 there, which is quite a bit of ways away. I don't think it'll get up there without some type of a pullback. But XBD here, broker dealers, also has been a powerhouse move here, but it is a little lofty up at these levels. Again, would not be a buyer up here. All right, let's flip over to energy here. So crude, again, kind of got a little bit of a bounce this week, did back off on Friday, so kind of was rejected at that 200 moving average and 20. I still think there's one more, we're close to levels here, but I still think we got one more little dip down here in crude, and then we'll have a really good buying opportunity. Could be a very good long-term bottom here in oil, so definitely getting ready for that. But for now, it did back off from the 200 and the 20 moving average, which are kind of intertwined there on the daily time frame. Weekly, you can see it's kind of just fighting with that 50 moving average for right now. You did kind of get a bounce off of this long-term trend line though, so we'll definitely continue to watch that. I still think it wants to go down and get closer to that 20-month moving average, somewhere in that area long-term. But in any case, looking for one more little dip here, and then it'll be time to get in. XLE though, some of the energy stocks actually held up a lot better this week. Was expecting a little bit more weakness here, but they had a nice bid this week. And now you have a daily chart higher low here on XLE. So this is actually holding up okay. Still may have a little bit more of a dip in it, but for right now, they're hanging on. And XOP also making a daily chart higher high, so that's showing a little bit of leadership. I will say though, OIH, oil services, we did trigger an inverse head and shoulders here on Friday with that close. So this may have already bottomed. So take a look there, OIH, you can see that inverse pattern pretty clearly. And if you wanted to trade this, you can. I would just put a stop right below here and just don't let it close there below on a Friday. So no Friday close below that trend line. And that should get you back up to about 280, 285, maybe around this gap fill if this does play out to target. But any weekly close below this trend line invalidates it, so just be aware of that. But OIH possibly has bottomed already, so we'll definitely keep an eye on that moving forward. Nat gas here, so bounced off this trend line. Boy, this trend line has been money really since it started May of last year. I mean, it's been a really good level for nat gas here as support and resistance, so both support and resistance. But getting a bounce there off that trend line. I believe the Freeport facility, they got shut down last month, saw some increased inflows. There was a story came out, had some more increased inflows and increased demand. You know, it was higher than expected, so that was kind of your catalyst there. Overall, though, you held that trend line. We back tested it, you know, kind of back tested that 50 moving average and got a bid. I wouldn't do anything with it right now. It's too high on the chart for me to put in a long, and then you do have that big reversal candle there, still from the 26th of July that we're going to go up and test now. But you know, all things considered, nat gas is holding up really well. It's really strong on the charts and definitely needs to be respected here. Let's take a look here. Let's flip over to uranium. Let's look at CCJ. So CCJ kind of in a range here this week, not really participating much in the rally, but you know, this is a little bit more of it's a commodity specific stock, so doesn't always trade in unison with the general equities. But overall, you know, I like the pattern it's putting in here on the daily. You know, you got a nice little green candle here, big green candle, two of them, and kind of just inside bar here. So it's just consolidating right now to basically attack these pivots. So nothing's really changed as far as the price targets. I think I told you guys, it was maybe the gap fill, I think 27, yeah, so that gap fill, 27.36 would be kind of your resistance on the upside. But it's consolidating here, and if the more it does that, the more juice it can have when it starts to bid up, and you can see the URNM doing the same thing here. The only thing I don't like on the URNM is you got these lower highs here, but all things considered, you know, you got a nice bullish inside bar here, and the more that consolidates, the more juice it'll have. So the more minor, essentially, you'll make that 200 and this pivot here. So nice little patterns there for uranium. I don't hate them. They're definitely holding up well. And again, CCJ, obviously the strongest name. It's really just been holding that trend line here for quite a while here, going back to really January of last year. That's been a good trend line for CCJ. Anyways, let's flip over here to the dollar index. So DXY. So tried to break this trend line here earlier this week on Wednesday, and then we kind of just had a little pause candle, and then we closed right back above it on Friday. So if you take a look at the weekly, it's really nothing more than kind of a pierce. So there may still be a little bit of upside, excuse me, upside in the dollar index. I believe I told you guys, you know, I was looking for like 110 here. I would have felt a lot better about calling a top in the dollar if we hit that 110 level. So that may go up there and do that. So we did reclaim that trend line by the end of the week. So dollar index is still hanging in there for now. And again, if rates do move higher, like we were talking about, that would obviously, you know, that could be your kind of catalyst there for the higher dollar. So we'll keep an eye on that. Gold, conversely, actually holding up despite the dollar getting a bid on Friday. So gold and the dollar were green Friday. I like the pattern here. I just want this to consolidate a little bit more here on gold, but you know, you're basically back to that breakdown bar from July 5th. So gold's hanging in there okay. I do like the pattern here on the miners. You know, we kind of stair-stepped up, a little gap here, consolidation, gap, a little more consolidation. So I'd like to see a little bit more backing and filling on gold and the miners, but I do like the pattern here so far. And if this can consolidate further, it can make that 200 and 100 moving average more of a minor resistance level. The more you consolidate, the more compression you can build for a move to the upside. And then same thing with silver. Silver got a nice bid on Friday as well. We talked about this kind of pattern here on Friday, this bullish inside bar. We got a little test candle, and then Monday got a nice bid, 1, 2, 3 pullback and a pop on Friday. So silver's hanging in there okay. Still same thing. I would like to see a little bit more backing and filling. But overall, it's holding up all right, and that $18 handle was really a good level there, and it's got a nice bid off of that. So silver hanging in there okay as well. Platinum also has been a powerhouse since that 820 level. I think this can definitely be bought on dips right now. It's a little stretched here. You know, you went up and tested that 200. So if this pulls back into maybe that 910 area, I think that could be a good buying level there for platinum. And Palladium did have a nice week as well, participating in the metals rally, but it did back off a little bit on Friday. And then copper also finally getting up to that, I've been telling you guys for a while, that 370, 375 area. We got up there, basically kissed that 50 moving average and kind of a pause candle on Friday. So probably has some type of a pullback here in the cards, but after that, I think you can have another little kind of zigzag up there. All right, let's flip over here to Bitcoin and just cover the coins really quickly. So again, Bitcoin kind of just stuck in this kind of holding pattern. There's nothing wrong with it. It's, you kind of had like a little pullback and then just kind of a float up, but still not participating. It's noticeably weaker here than the rest of the market. And again, this is another thing that's really saying that we're not really seeing full risk on here in the broad market. Otherwise, you would see crypto really starting to bid as well. And you can tell investors are still nervous about, it's like every other week there's a new trading desk blowing up or some fund that's, exposed that's blowing up. And it's really causing kind of skittishness in this kind of environment. And it's contradictory to sort of the risk on talk that we're seeing in general equities. But overall, it's holding up for now. I still think there's a good chance you can get up to that 25.5 area, maybe 26. But Ether is a little bit noticeably stronger, and that finally got up to that 2,000 handle that I've been talking about for a few weeks. So Ether's in a little bit better shape here. Probably does need to pull back a little bit here off that 2,000 psychological level. There's also, there's a lot of resistance here. This is where, we broke down, and a lot of bulls are trapped in there, so they'll turn into sellers here. But Ether holding up okay. Bitcoin just a little bit on the weaker side, and it's noticeably weaker here in the relation to the broad market. Anyways, wrap up here. We have to respect this rally in the near term right now. When you get these short squeezes, they can go a lot higher than most people think. We do have some resistance up here though, so I do expect that to come into play, possibly this week. We do have options X this week as well, so a lot of the people who had puts for August are already probably burned out, so those puts are really, there's not much incentive for the market makers to really burn those. They've already been fried. So at this point, maybe you've got a lot of retail buying calls up into this area. So if we're up Monday, Tuesday into this level, I do expect us to probably pull back into Thursday, Friday. Overall though, we got to respect the rally. You got to respect the light volume. I've been telling my members every day, we can't, expect a lot of selling here until that volume really picks up. Once we get that volume to pick up, I do expect the market to start to consider the fact that the Fed's not going to be able to save us. And, I think the bond yields, the bond market is really kind of confirming that thought here. So keep an eye on that yield curve. Keep an eye on the VIX as well. This is way, way, way oversold here on the daily and weekly time frame. So keep an eye on the VIX, keep an eye on the 2-year, and definitely be watching that volume. If we see a volume start to really pick up, we could see some sellers coming back in. Anyways, guys, going to wrap it up here. You guys take care. Have a great rest of your weekend, and I will talk to you all next week.